Here's the problem. If your personal net worth, including the fair market value of your business, will exceed your lifetime estate tax exemption when both you and your spouse pass on, the IRS will require your family to write them a check within 9 months for as much as 40% of everything you own in excess of your lifetime exemption. And if your heirs don't have the cash to pay the estate tax, and if they don't or can't sell off your assets within 9 months, the IRS will seize control of your entire estate, including your business, your real estate, and your stock portfolio, and then sell off the most valuable assets to cash-only bargain hunters, including competitors and liquidators, for much less than fair market value. So how can you prevent this from happening to your business? With an estate tax insurance trust. An estate tax insurance trust enables you to gradually transfer a relatively small portion of cash assets out of your taxable estate and into a tax-exempt family trust, and then use that money to purchase an insurance contract that can pay off your entire tax liability with tax-free cash at a discount of at least 70 or 80% without selling off any of your assets. Even if your present net worth does not exceed the lifetime exemption, the appreciation of your assets over the remainder of your lifetime will almost certainly become an estate tax liability for your family and a potentially devastating threat to your business, especially if the federal government decides to decrease the lifetime tax exemption or increase the estate tax rate on wealthy families. For example, consider a married couple in their mid-60s with a current net worth of $5 million. If their assets continue to grow at an average annual rate of 7% over the next 20 years, their taxable estate would be worth almost $20 million by the time they reach their 80s, and the tax on their estate would exceed $4 million. That's more than 80% of their present net worth. In addition, they could also lose as much as $4 million more if their family was forced to sell off some of the assets within 9 months, especially as prospective buyers become aware of the urgency. So this couple would set up an estate tax insurance trust and transfer $20,000 into the trust each year. The trustee would then use that money to secure a $4 million insurance contract on both husband and wife that would pay off on the second death. This has the effect of reducing their taxable estate by $20,000 each year while also increasing their tax-exempt estate by $4 million. Now, assuming the second death occurs in the 20th year, the insurance would deliver a $4 million check to the trustee, tax-free, at a cost of only $400,000, $20,000 paid annually for 20 years, which would save the family over $3.6 million in taxes and as much as $4 million more by avoiding any forced liquidation of assets. An estate tax insurance trust can minimize your taxable estate, maximize your tax-exempt estate, leverage your annual tax exemptions, and pay the entire tax bill with tax-free insurance at a discount of 70 or 80%. That's why these trusts have been approved by the IRS and used by thousands of American families for more than 50 years.